When the Chancellor delivered his fifth budget speech in Parliament, the tone was fiscally neutral, but some commentators believe that some of the proposals had a very clear end objective politically. This is hardly surprising, given that the next general elections are about a year away. There was an element of chest thumping, perhaps justifiably so. For the first time in his tenure as Chancellor, George Osborne was delivering the budget against the backdrop of an improving macroeconomic environment. The politically independent Office for Budget Responsibility, the OBR, has revised up its forecast for growth for 2014 and 2015. As a result, on current estimates, the economy is expected to achieve its pre-2008 stature sometime in the latter half of 2014. There were four key policy initiatives. 1. A continuation of the fiscal consolidation begun in 2010. 2. A beginnings of a policy-led effort to improve the structure of the economy through export growth. 3. Supply-side initiatives to support infrastructure development and incentives for businesses to increase investment spending. And finally, and perhaps most unexpectedly, radical and far-reaching reform to the savings market, particularly the segment aimed at the elderly and or the at or near retirement age populations. First, policy continuity. Using independent estimates of the OBR, the Chancellor was able to demonstrate that the path to fiscal consolidation, as contained in the original 2010 blueprint, may have had some delays, but the directional intent remained intact. Underlying public sector net borrowing, or PSNB, which hit its peak in 2009 to 10 at 11% of GDP, is expected to halve to 5.5% of GDP during 2014-15, and then expected to continue downward until a small surplus is achieved in 2018-19. As a result, overall government indebtedness is expected to peak at 78.7% of GDP in 2015-16, before turning lower and ending at 74.2% of GDP in 2018-19, which is the end of the OBR's forecast period. Given the OBR's growth forecasts, however, what this actually means is that the improvements in the fiscal deficit position are largely cyclical. Structurally, the imbalance in the public finance position remains pretty much where it was at the time of the original OBR estimates. Speaking of the growth forecasts, the story right below the surface of the OBR's superficial good news remains somewhat sobering. The composition of the recovery is still unbalanced and heavily reliant on ongoing household consumer spending and the property market. While business investment is expected to improve, the OBR does not expect it to reach its pre-2008 level as a percentage of GDP over the forecast period of 5 years. Given this mismatch between the growth in the economy and growth in the supply capacity of the economy, the OBR expects the output gap, which is the slack between where the economy is currently operating and where it could potentially operate, to narrow and ultimately close out by sometime in 2018, thereby putting a sort of a lid on potential growth towards the back end of the forecast period. The Chancellor would argue that some of the proposals in his budget are aimed at addressing precisely these concerns around the output gap. So let's take a look at some of the key proposals. Exports. The increase in the export finance facility to £3 billion and a concomitant reduction in the interest rate charged by a third will certainly help. The export sector can certainly use all the help it can get. With a strong pound sterling and its largest market, the Eurozone, still not completely out of the woods, this support will be welcome. Similarly, the proposal to double the investment allowance for companies to £0.5 million has been welcomed by the Confederation for British Industry and should provide incentives for businesses to increase their investment spending. On spending too, the Chancellor has stayed close to his Conservative roots with a £119 billion cap on total welfare spending. The Chancellor will be hoping that the cumulative effects of these welfare spending reforms as well as a substantial squeeze on government departmental spending, will reduce the stake of government activity in the overall economy to its lowest since 1948 over the forecast period, as the OBR predicts. The crux of the budget, however, has to be the quite radical reforms proposed for the savings market, especially that segment aimed at the elderly and near retirement demographic. There are two key elements to this reform to the savings market. One, that annuities will no longer be mandatory, and two, a relaxation in the rate of tax charged on above threshold withdrawals from the pension pot. I expect the net effect of this will be A, increased flexibility for the long-term savers, and B, potentially increased revenue for the Treasury as lower tax rate encourages more above threshold withdrawals from the pension pot. Further reform to the ISA market, the popular individual savings account market, are also being seen as saver-friendly. Erstwhile separate cash and stock ISAs are to be merged into a single new ISA with an enhanced limit of £15,000 annually. Let's put this in perspective. The annual limit on the cash ISA is £5,760, and the annual limit on the stock ISA is £11,520. I believe this represents a significant improvement in terms of the opportunities available to regular savers, both in terms of the overall quantum as well as the flexibility that the new ISA affords them. Additionally, the Chancellor has proposed new tax deductions, which I think will have the net effect of improving household finances. There are three key elements to this. One is the improvement in the personal allowance. Two, the elimination of the 10% tax on small savings. And three, the enhancement in the threshold rate for the higher rate of tax. Collectively, I believe that this will put more money back in the hands of the households and enhance the flexibility with which they can save, spend, and invest their own earnings. Incrementally, these may look like small changes, but I believe that over the long term, these could have profound implications for the retail banking market as well as the long-term savings market. Equity markets fell by 0.5% during and immediately after the Chancellor's speech, driven down quite likely by a sell-off in insurance sector stocks as investors discounted the likely damage to come to insurance companies' financials from the loss of the pension annuities business. In the currency markets, the pound sterling maintained recent strength during the course of the Chancellor's speech and even rose slightly towards the end. Investors here were quite clearly giving a thumbs up to the budget. Bond markets too showed a pretty sanguine response. The yields of the 10-year gilt rose and then fell during the course of the Chancellor's speech, ending the day virtually unchanged. Much of the policy direction in the Chancellor's budget speech was either a continuation of past policy intent or reasonably well flagged and well signalled new policy initiative, with the exception of the quite notable and remarkable savings market reforms. The budget does not materially alter our outlook for the UK economy or for pound sterling denominated assets. UK equities and UK property remain two of our top four asset classes in terms of forecast 12-month returns, and we remain constructively exposed to them.